The second best thing to being right is being not wrong. I think that's how I describe my coverage this week. It wasn't wrong, but some of it was looking for things that didn't quite get there. Number one, came into this week looking for the breakout of the range. Didn't happen. Thought Nvidia and GDP together would be a good enough combined catalyst to get us out of generally the range we've been in. Instead, despite a really good push here in the last hour of the session on Friday, we still ended below, and we're still pretty much in the levels that we've been dealing with. So S&P's dealing with sideways behavior. The yellow light, I feel like, still applies. Okay, at least we didn't ramp up and get the breakout the day after I thought we would. But it actually makes sense. And I guess if you think about it now, the whole dynamic of the market shifting away from the AI story into other things, other sectors and stocks dependent on the economy, factor themes that depend more on the economy. Small caps, the equal weight is doing very well. Cyclical themes are doing well. Industrials have had a nice rally. Stuff that's more connected to the economy then, of course, probably takes its cues from direct economic information. And a GDP revision second round probably wasn't it. Probably the weight of employment next week will be the catalyst then to get us some definitive expectations for the September meeting, because there's still 30% left in there for 50 bips. We're going to have to probably answer that by next week. I don't think we go into the day of the meeting in a couple of weeks here with decent odds of 50. I think we'll probably get some more definition from the market. So that's maybe what's keeping a lid. Generally, though, it was a really healthy finish to the week. Momentum and value rallying together. The market does look quite healthy here. Here's the trade-off I do still believe, though. A healthier market, while I think more sustainable, is likely to be a slower one and is not going to be as gangbusters as our old everything rallies or the super hyper AI concentration rally, which now we're seeing has a tougher earnings trajectory ahead of it just because the bar is so high. So that's where this week we saw continued underperformance of growth next to value around the Nvidia report. The chart since July 10th, which I continued to normalize because that was the inflation print in July that set us on the first separation between tech and everything else, the first rotation. It fell flat, of course, as we came into this month with the big sell-off, but now we recovered and value is doing better. That's really important. The nature of the market has shifted here. And so that means we are going to take cues more from pure economic data than the tech earnings or some of the secondary stuff like the jobless claims. So that was a little bit of a misread on my end. Next week then should be bigger because you've got now stocks rallying together with yields. That's very good. That means the market wants to see good data. That means it's pretty straightforward. Yields look like they want to creep up. That's a pretty good message. I think you want yields in stocks to move. That one I did get right today because we did say at the morning you probably want bonds to sell off here to give it sort of everything's okay vibe going into next week. So we got that. Stocks rallying with it, and Bitcoin down too. That's the discerning market. That's not the crazy gambling market. It's one that's picking its spots. And so continue to separate quality from not quality, wheat from chaff is a pretty good setup into next week. We should have some decision by Friday. Enjoy your weekend.